Hi, and welcome to Market Sense. It's my new monthly market overview. I'm so excited. My name is Lynn Kitchen, and every month I'm going to take an opportunity to share with you the knowledge that I have gained over 48 years of market research, portfolio management, first professionally for 24 years, and then uh, in my own life to help others truly make better financial decisions and build wealth over time. So, tonight we're going to be talking about the market turbulence and how it creates opportunity. And here we are, the first week of August, and we have had a rock and roll month so far. And it really does feel like there's some volatility that has been going on, certainly a lot of turbulence. And this is how it feels. It feels like we are being rained upon by sharp falling knives. This is what it felt like, certainly on Monday morning when the NASDAQ 100 was down over 1,000 points. But believe me, it is not going to stay that way. I do believe that we're going to be in a correction, not a recession. And so going forward, I want to talk to you about how market turbulence does create opportunity. Well, let's go back to those charts really quickly. We can see that around the world, whether it's the FTSE 100, FTSE market in Britain, or the S&P 500 in America, or the Nikkei 225, or the FTSE Euro First 300, they all have been going down as if one part of the world sneezes and everyone else gets a cold. Well, it certainly has been the Standard & Poor's 500, a very sharp pullback, but nothing like the Nikkei 225, a very, very sharp pullback. And these lines represent a 200-day moving average. So much of those markets have come down nearing or sometimes exceeding that 200-day moving average. And that's why it has been feeling like market drop, like sharp knives coming onto our heads. But we are in an opportunity of what I called wealth builders. And I have a group of ladies, we get on the train together called the Wealth Builders Express train. And every Wednesday we pull together and we talk about what's going on in our lives. How can we look at our portfolio, be prepared? And we are prepared. In this correction, our team of Wealth Builders Express members have been so excited to have already done in the past, getting ready for the possibility of turbulence ahead. We've already protected our portfolios. Last week, we had an entire teaching on how to protect portfolios. You may want to check our past broadcasts. But for today, we're so excited that most of our members are feeling more that we have controlled the emotions that we often find in investing. Our goal is to learn how to be calm and confident investors, especially women, especially couples that are working very hard to take their earned income and maximize it over time so that they can retire more early and so that they can have the impact, invest in their dreams, support their children, and have a wonderful, impactful, dream-filled life. And it takes something like controlling one's emotions to really become a investor where that kind of wealth building possibility is possible. This is what we want to feel like. This is what it feels like to be a calm, confident investor, where the turbulence is happening around us, on top of us, but actually we are protected. We are very, very well protected by means of in the proper investing and investing in quality, quality, quality. Because we do know that whether it's in real estate, location, 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 stock market, quality, 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 bond market, quality. The important thing is that everything in a correction or a bear market goes down in price, in value, but the quality investments come back first. Sometimes the non-quality investments, those that have too much risk involved, they stay down and never come back. I've experienced that so many times in my life. But those of us who have quality portfolios, that we are invested in companies that have consistent and persistent rising earnings over time and solid financial underpinnings, as well as solid, repeatable cash flow, this is how we feel. So that's our goal inside not only Wealth Builders Express, but Money Talks for Women. And let's just take a look at, once again, the emotional cycle of investing. I think that this is a chart that you've all seen me use before, but it's instructional because you can kind of gauge within your own self where you feel and match that to the actual cycles of the markets. As we can see here, markets are nothing more than waves of energy moving through and shifting the different valuations by means of investor sentiment and perception of the future. But it mirrors our own individual wave of emotions as well. So let's just take a look at the very top of the market, and we can say that perhaps this last month or so of July, in retrospect, we won't know until later, but in retrospect, at least short term, we may have seen the top of the market for a while. That means that it is an inflection point. And there's a real characteristic as it pertains to inflection points of all waves, and certainly the stock market and the bond market and the real estate market and the commodity market can be seen in terms of wave theory. But what happens at the very top as we move up from optimism, excitement, thrill, and you've all felt that this year, Nvidia going up, the FANG stocks going up, and the euphoria over many of the asset classes like Bitcoin and so forth have had this thrill quotient about them to the point that there was a feeling of euphoria. And why is it that this chart shows that at the very top of a market, we would all say, we can say that that is the maximum point of financial risk? Why do you think that that's why this chart says that? Why are we at the peak of financial risk when we are at the top of the markets, or very, very strong top of the markets? Why do you think that that is true? Do you feel like you are at risk? Do you feel the highest maximum point of your personal financial risk when you went through the top of the market just last month? Probably not. You were feeling euphoria and probably blind to the fact that what was actually going on is that you were experiencing the maximum financial risk point. That is an inflection in which um, investors often suffer from that type of investor denial. But what it does mean is that this is actually an ongoing wave. It doesn't stop here. It moves down as the markets move down, and often quickly through these emotions: anxiety, oh my gosh, what's going to happen next? Denial, oh no, this can't be happening to us. Fear. And then you look at your portfolios or you look at the markets, and suddenly this is no joke. This is a downward spiraling market, and the whole world is happening at the same time, moving downward in unison, almost in a cathartic manner, we felt that this week. Well, this week's not even over, but on Monday of this week, when the NASDAQ 100 was down over 1,000 points, there were many in the financial press that felt like we were in a panic mode. Well, of course we were. That's what happens in a downward trending market. Now, one of my clients asked me the other day, is this what it felt like, Lynn, when you were managing money during the 1987 crash? Because I was. I was a professional money investment advisor starting in 1976. So this goes back a long way that I've been managing portfolios and experiencing the ups and the downs and the ups and the downs. And so the question was, does this feel like the crash of 1987? And I said, no way. No way. This is like a little blip. This is just like a little tiny blip. The crash of 1987 was real panic that did not stop. And those knives that were falling knives went on and on and on. And it was a disaster with a lot of damage at the end. Well, sometimes it feels like that in a very short correction because the energy of selling, the selling energy can be very fast, very quick. And before you know it, the markets can unequivocally shift the valuation. You wake up the third day and you scratch your head. How could that have happened? Why didn't I see that happening? Why didn't I see that coming? Well, you're not alone. There's an awful lot of factors of what was going on in the world that very few people actually did see, and this is usually the case. We see it after the fact. Lots of money moving around the world with private investing going on, especially the rise of private equity and private credit. So many investing is going on underneath the surface, so to speak, or underneath the transparency factor. So, unfortunately, we happen to be living in a time of murky transparency, which does increase the risk overall to all of us as investors. But these kinds of invisible trends, when you have huge amounts of money following one particular action and then suddenly everybody sells, that is what we call a correction. So it's important for us to really understand that at some point in time, that correction will come to an end. It may go through what we call capitulation, which is, the amount of sellers evaporate, and finally the buyers come in because they feel there's a good valuation happening. In other words, people buy on the dips. Many opportunities. What as for me as an investor, I'm always looking for opportunities to buy on the dips. And what is it that we want to be buying on the dips? We want to be buying quality because, as you know, the valuation of markets go up and they go down. And when they go down, it's a perfect opportunity to take advantage of the cash that you have on the sideline and buy the highest quality investment that you can find. Why? Because the assets are on sale. This is the sale time. So that's why I'm saying market volatility gives us opportunities eventually, but we do have to wait for this motion to move through the markets. And it does happen. This is a very popular chart that I've used over and over in my teaching. And that is that on the left-hand side axis is GDP, gross domestic product. On the bottom axis is time. And over time, what we are seeing is a simple business cycle, which has a construction just like this: expansion, peak, recession, trough, expansion, peak, recession, trough, expansion, peak, recession, trough. But notice there is a consistent 45-degree angle upward bias over time. Over time, this is how our markets have been trending in the United States, as a matter of fact, in the world. Even the third world countries are moving up in structure, in status, and in the quality of their lives. So we can say that, yes, there's still parts of our world that is sluggish, but most of the first world markets have been re, a positive a positive output gap, and then an adjustment, and then another burst up forward, and then an adjustment. That adjustment happens to be called a recession. It can also be called a correction. It depends on how serious or how volatile that actually is. But I can tell you that, having lived through many recessions going back to 1976, at least six serious recessions, this looks as if it does not qualify. It could be, and many pundits have been saying, that we have actually been living through a rolling recession already. We have experienced commercial real estate moving down already. We've experienced the automobile industry moving down already. We've experienced several key industries in our economy already having moved down. So in a rolling fashion. But what we're looking at now, with the possibility of the Federal Reserve potentially shifting from their former policy of keeping rates higher for longer to the possibility of moving rates down soon, things can shift now. So the real question is, will we have a soft landing so that we are not moving into recession, or will there be a harder landing and a potential of a lightweight recession? We need to wait and see. We will be waiting and to see. But this is the key element of um, why we believe that the if there's going to be a recession, it'll be a very light recession. This is a chart, the source of which is Oxford Economics, and it's recently a recession probability is low in the near term. So they agree with me, or I agree with them, that this is the threshold or the probability for recessions over time. And here we have 2000, 2005, 2010, 15, 2020, and here at 2024. So this really is a 24, 25-year chart that gives us, here we have the threshold, 6-month threshold of recession, and the probability in blue of a 3-month recession or a 6-month recession in red here. It is showing a very low probability, below 40%, either in 3 months or 6 months, to have a recession in our future. And I think that that's very instructive, and bodes the point that as we are in this moment of volatility in the market, it's a time in which collectively, I believe that corporations are making decisions similar to investors, meaning wait and see. We need to wait for the markets to come down and see exactly how much more on the downside that this correction can happen. We need to take a look at it as a healthy, cathartic movement, because any market that has been stretched so far, so high, so long, as we have experienced in the United States stock market so far to date in 2024, beginning in October 2023, that movement of over 34% in one direction means that we must expect some kind of a contraction. It would be healthy, it would be cathartic. And that's indeed what we're experiencing this week in August of 2024. Does it feel good? No, of course, because we are looking at the possibility that we want everything to go up forever all the time, don't we? But that's not the real world. The good news is that we believe that there is a very low chance of recession and much higher chance of everyone just waiting to see so that we can have a potential softer landing. I want to just end with this chart on the United States 10-year treasuries. This is a chart of the yield of the treasuries and how over from 1965, so this is a long-term chart, we can see that it peaked up here at over 15% in the 1980s. I remember those times. In the 1980s, we had high inflation, 20% inflation. We had interest rates as high as 15, 16% at that time. Those people now who feel like we're moving or having had inflationary fears don't even remember what it was like in the 1980s when interest rates were that high. Can you imagine trying to purchase a house during that time and having mortgage rates so high that you really couldn't afford it back then? We actually have been spoiled, quite spoiled, over this total downdraft of the direction of interest rates and bond yields over a 40-year period, which is really the breadth of my career, shows that um, the interest rates, as demonstrated by the United States 10-year Treasury yield, has come down so far up to right here at the pandemic. We had the markets began to move back up again. The Treasury bill market began to move back up. And very, very quickly as the Federal Reserve raised their interest rates, right? But here we topped out. It looks as if we have topped out right at 5% on the 10-year Treasury yield. It hit 5% and stayed there for quite some time over the last year, but now has dramatically, as of this week, moved or contracted to about 3.8%. What does that mean? Well, that means that the possibility of the Federal Reserve staying high interest rates for longer is not going to necessarily be the most popular opinion. In fact, there's been a lot of pressure on the Federal Reserve just this week saying you're too late, you're not lowering your interest rates fast enough for us. And as a matter of fact, the bond market has been saying the same thing. You're way too late. The bond market collapsed, or from 5%, the yield went down quickly, over 50 basis points in 1 week, from 5% down, or 1 month, from 5% down to 3.8%. Very dramatic. And what the bond market is foreseeing and foretelling is the possibility that future inflation is not really the enemy or the big risk factor out there. In fact, the bond market is foretelling us that the real possibility of risk is deflation. Deflation meaning interest rates coming down. And when that happens, it can happen very quickly. The markets can have more volatility ahead. So let's take a look at where we are actually in the markets. And I'd like to just pull up on my charts the Standard & Poor's 500. This is a 5-year chart of the Standard & Poor's 500, a bar chart that we can see from 2020 during the pandemic. that really the markets have been going extraordinarily upward. That 45-degree upward is intact, even though we had a top of the market right here in 2022, right there. And then we came down, bottomed out here in July of 2023, and another bottom here in October of 23, and then a major shift upward in from October to uh, July. And right here, we have had a downward movement to almost to this line, which is the red line. That is the 200-day moving average. So just in 5 trading days, the markets have moved from a very high to almost touching the 200-day moving average. Not quite. But does that look like it's a crash? No, it doesn't, because it hasn't even really come down to even touch an average price. But if we were to look at this Standard & Poor's 500 now, as it relates to a 5-year chart, I'm going to do some magic for you. I'm going to shift this chart down into what I call a compressed status by using something called a point and figure chart. And this point and figure chart is always like a bit of magic, because you're squeezing out the air, you're squeezing out the time, and you're just looking at the price movement. And so this is a price movement. Once again, we can see that the markets, the Standard & Poor's 500, went from a low here in 2020, as I had mentioned, and up a major top formation here in 2022. Then we had this cup almost a cup-like formation all the way up to the top, but there's been very little pullback. This amount of pullback right here in the zeros has an indication that we haven't really seen a correction at all that threatens the upward mobility, the upward trend of the Standard & Poor's 500. In other words, there's been no threat of having pulled down under a support price range. Should it have, I think the next price range that we need to take a look at as a support would be right here, and where where this particular area of concentration has begun, and that would be right at about 5,000 on the Dow. Well, right now it's at 5,300 and change. So if we have a further decline in the market, I think it could easily go to 5,000 without us having any kind of a sweat at all. If it moves below 5,000 toward underneath this, and this begins to come down after that, that would be an indicator of a little bit more distress in the market. So we don't know exactly how much more on the downside that we will be receiving. However, what we do have a tendency to be able to see is that the markets are still in a very strong upward channel. And you can see that here in the Standard & Poor's 500. We still are in an upward channel, even though the markets have come down quickly. They have a long way to go before it breaks the 5,000 mark, which is right at the lower point previously in April of 2024. So we have a long way to go before we can even be in harm's way for a major kind of a correction. Therefore, what I'm here to say is that good news is I believe we are in a normal correction. We are in a healthy correction. We are in a cathartic correction. This is an opportunity for us to make sure that we have cash on the sidelines that can be ready to allocate once we do have the patience to allow this correction to blow over. And as savvy investors, then we can begin to purchase the highest quality companies, whether it is stocks, bonds, commodities, real estate, whatever the asset class, gold. It is an opportunity in the waiting, in the wings, and it's coming. So there's always going to be volatility in every market. That's what happens in the markets. The important thing is to prepare when the markets are very, very strong, to make sure that you are protected. And then when the markets move down, we're in the patient mode. We're calm, collected. We allow the markets to just find their normal settling point, what we call um, the um, point of support, the support levels. And that's when we can move in to purchase some of the highest quality companies in the markets today worldwide. So, with that, I will leave you for today, and I thank you for stopping by. Please, if you've enjoyed this, please subscribe down below and make sure that you like the broadcast, and we'll be back with you every month, the first week of every month, with Market Sense with Lynn Kitchen. Thanks very much. Bye for now.